Well, good afternoon, everybody, and thank you for joining us for our attempt at a birthday party here. As Ken and I were just saying here in the green room, it's kind of hard to believe that we've been doing this on Tuesday afternoons for a year, and we seem to be noticing that type of phenomenon with a number of things that we've been doing that before you know it, you're talking about 2 years, or in the case of the roundtable, 11 years. We'll be starting our 12th year in a week. It's kind of an amazing thing. My name is Mark Robertson. I am joined here by Ken Kavula and our special guest, Kim Butcher. Say hello, guys.
Hello, everybody. Glad to be here.
Hi, everyone. Yeah.
I hope you're having as gorgeous a day wherever you're living as we're having here in Michigan. It's absolutely beautiful outside today. So.
Yeah, we've got rain, thunderstorms, and chance of flooding.
Well, we only get 7 of these a year, Kim. So, you know.
Yeah. You're entitled to more.
Yeah.
A pure Michigan day is an important thing at this point. All right, so like we say, it's been 1 year running with the Bull, so we just want to kind of pause and think about where we've been. I think we've been some pretty fascinating areas, and based on the feedback I got from a number of you here over the last week, you think so too, and we appreciate that. The thank yous down at the bottom are aimed at anyone, including all of you, but anyone who has participated in terms of contributing content or serving in the back room. And just so you can put faces to names, Pat Donnelly's brought us a few stock picks. Hugh McManus did a mini-series on financial statement analysis. Herb was actually a host here a couple weeks ago while Ken was out running around on the roads, and Matt Spielman is with us here today, and he also has filled in several times over the last year. So again, thank you. And it's an interesting experiment, and I think we'll just keep experimenting until we decide that it doesn't make sense to keep experimenting. So with that, I'm going to go ahead and get us started. You guys all know the drill. No investment recommendation is intended. We will talk about real stocks in real time. Everything we do here is in the spirit of education and demonstration. We are here to illustrate a philosophy, the techniques, methods, and basically approaches to successful investing as put forth over the last 8 decades by the Modern Investment Club movement, whether it be the teachings of Better Investing, the National Association of Investors, or Manifest Investing. You'll hear opinions from us. We do try to disclose if we own a particular stock, and just please be aware of that. A week from today, we will be celebrating our 11th birthday at the Roundtable, starting our 12th year of operation. That is our monthly webcast that is on the final Tuesday, in most cases, of every month at 8:30 Eastern Time. And the rate of return on that portfolio used to be about 19.5, and it's down to about 18 this morning. We'll talk about why here in a few minutes. But 18 is still pretty good. If you'd like to be added to a reminder list about that event, that educational event, actually idea generating and sharing event, send an email to nkavula1@comcast.net. You will not get inundated with email, just simply a couple of reminders whenever we're doing the roundtable stuff. If you have follow-up questions or suggestions for future topics, or if you'd like a copy of the slides, all of these sessions are posted at Manifest Investing in the forum, and we'll show that. But if you do have a special need or need a helping hand, just send me an email at markr@manifestinvesting.com. Anything you'd like to add to that, Ken or Kim?
Nope.
All right. So here's just a quick... I actually don't like chocolate cakes. I should probably found a vanilla one or a Costco cake or something there, but that cake looked pretty good to me, so I went with it. But what you see at the top is actually from a forum post at Manifest Investing in the forum, or accessible from the homepage. If you just click on the bull session, those are hot links to the old sessions where you're actually taken to the forum page that includes a link to the YouTube video and the PDF of the handout materials for any one of those events. So if you see a topic, if you're new here and you see a topic up there that you're curious about, you can go ahead and from the Manifest Investing forum, you can actually click through to any one of them. We do collect up a number of topics that we will be covering in coming weeks in our bullpen. And I think one that's inescapable now, Ken, is probably the inflation topic. I think we probably need to tackle that in the next couple of weeks, just because there is so much discussion these days, chaos and confusion with respect to the subject. So we'll probably have to air that one out here pretty soon.
I think it'll be interesting also, Mark, to try to figure out in the next year or so how inflation, if in fact it does start to run, how it impacts that proof number. We know that it impacts par numbers, especially the way that you might come up with a par number. And I would be interested to ask myself the question, does higher inflation, and by that I mean significantly higher inflation, does it impact any of those proof numbers? I'd like to kind of keep an eye on that as we go forward.
I think it's a great suggestion. I mean, I had a similar thought just a couple of hours ago about how inflation is notorious for its impact on PE ratios. Well, the PE ratio is kind of subdued in the projected return on value. And then I think we may have mentioned this before, but Nicholson spent a lot of time talking about the beneficial side of inflation with respect to a stock selection guide. And I think that's where it comes in, Ken, in the numerator of the calculation. Yep. That's completely an SSG outcome.
Yeah, absolutely.
So some good fun there that could be interesting. And yeah, I think we probably have to go back and look at it, perhaps even over the decades, to get a good look at that with respect to the impact of inflation. All right, so we're going to go through a series of slides here today. We're going to start with our chart of the day on Ardelyx past the Motrin. Ouch. You'll see why. But then we'll talk a bit about the Groundhog Challenge and a few other things as we go. Let's go ahead and get underway. All right, here's the chart of the day. This one hurts because I own shares in this. My wife and I own shares of this company. It even hurts more when I'm told that Ken used to, formerly a shareholder, emphasis on the formerly, because this was presented at the round table over the last several years, several times. And we ended up buying a number of shares at approximately $2 a share. Our cost basis is probably somewhere between $2 and $3. And it had gone all the way up to $9 not that long ago. And it went from basically $8 a share to $2 a share in about 10 minutes yesterday afternoon. And that's what you're seeing there. So this one hurts a bit. We're kind of back to our cost basis, but we're talking about a pretty good chunk of our speculative portfolio doing the speculative thing. And it's a powerful reminder about how any biotech stock can literally lose 70% rapidly, and can't be surprised by it. But I can't say that I'm thrilled. But Kim, have you gotten to the bottom of any of this yet, or any thoughts on what might lie ahead for the company?
Well, all I can say is double ouch, double doses of Motrin, first off. Second, when I looked at the filing and read it, I looked and saw where it said, I'm looking up the information on it. I believe the interpretation of what they're saying is the FDA had come to them and said they had a labeling issue. And so then they said that it implied that they needed to do more studies. So they did 3 more studies. The studies came back therapeutic, that they were able to get patients in the
Oh, Kim, did you drop out?
Yeah, she went blank. Mark, I just called Ardelyx up on one of my news feeds. It's trading at $2 and a penny right now.
morbidity issue. So I think that their database of their study was 1,000 people. I'm beginning to wonder, is that the issue, it was only 1,000 people instead of 10,000 people or 100,000 people. I'm wondering if the actual study was not of enough people within the study itself. The second thing is, many of you are aware that Biogen just had a drug approved for Alzheimer's, and then 2 weeks later, 3 weeks later, they came back and had to rescind. And I'm wondering if any part of that is with this. And then my third item is with it is the big reason I had heard about this stock with Hugh. I had watched it go up. I had watched it start to climb, and I got interested in the stock personally when David Mott, who used to be the CEO and chairman of New Enterprise Associates, which was a $1 billion hedge fund that dealt with biopharmaceuticals, when he put his own money and bought approximately $1 million worth of shares in June of last year, and then in December, because the price had fallen down to like $5.78 or something, he bought another $1 million worth of shares. So he had ultimately, by the filing, looking at it, and it had a big fat D as a direct purchase, not an indirect, like a residual stock option or residual stock unit that was paid out to him because he's on the board of Ardelyx, that he'd spent his own money, bought the stock himself. He put it in a family trust and all this, and in his one of his kids' trust, I think it was, or wives. The big thing is he spent his own money. He just didn't use money that was given to him free, and he had bought more. That's what really piqued my interest on this, because he was certainly putting his money where his mouth was, thinking that this was going to be a great stock, because he also had brought a stock to market and sold it to AstraZeneca for like $1 billion. So I really felt he understood the market, he understood what was going on, and I felt he knew how this stock could do well.
Mm-hmm.
So did I swallow big and have a drink last night? Yes. What am I going to do since then? I've decided that I do not know what the rules and regs and paths are with the FDA, because Ardelyx did ask immediately, can we have a discussion about what's going on? And they immediately said no. I don't know if that's what they routinely do. I don't know if it's what they routinely do and make you wait 6 weeks, because the filing also said that this was not their final decision, which was under review of the documents that were placed forward. So it's kind of like it's just hanging in here, and I don't understand. So my feeling is if what got me interested is Hugh talking about it and an insider purchasing a heck of a lot of shares. And Mark, you can tell me in the audience, who was it that a small cap hedge fund who you really believe in, they also have these shares?
Yeah, Rock Springs continues to have them as far as I know. Yeah, there's just a couple things. First of all, I did reach out to Hugh. He is in Europe. He will be getting back, and we'll get a chance to ask him some of these questions. There's a couple things that can be stated as fact. They had a PDUFA date, an end of their phase 3 trial, scheduled for July 29th. Now, that could have been deferred, but there are a lot of people that believe that they are looking at a potential rejection. So that's just that's an opinion. That's a guess, but perhaps a projected rejection on July 29th. My thinking is, whatever they were doing showed promise. There still are 753 million people out there in the world that have some stage of need with respect to this. And the one other thing that just kind of gnaws at me a little bit, and then Ken, I'll let you explain why you changed course. But the fact of the matter is they still do have a strong balance sheet. They basically have $2 of cash in their wallet per share. So You know, again, any interest in this company would be absolutely speculative at this point. But I will tell you that it's not comfortable to lose approximately 80% of a gain and go back to where you started not that long ago. It's been quite a run. And in closing, the roundtable tracking portfolio does have 8 or 9 positions in this company, and we're going to take quite a dent unless this thing recovers in the next week. So it's one that's pretty close to us, and it's higher on our radar screen. Now, Ken, on the other hand, is celebrating. I believe you very definitely exited your position.
I'm not celebrating. What I'm doing is I don't speculate very often. I really don't. And when Hugh made this announcement that this was a stock with something going to happen, he put a date on that going to happen kind of thing. And the date was last September. That was when this whole thing was supposed to have been concluded and begun to go to market. And when September came and went and nothing had happened, my discipline basically said, you know, I bought this on a story. The story didn't come true. Take whatever you have gained or lost and be comfortable with it and leave the stock. Now, at that point, I happened to have been up about 4.5 times what the stock cost. So it was an easy thing to exit the position, take the profit, and it was in a non-taxable account, so I didn't have to worry about short-term, long-term gain, that kind of thing. But just take the gain. If it went on to make huge amounts of money, then I could be kicking myself. But I'm watching everybody else kicking themselves right now, and unfortunately, I'm standing on the sidelines this time. Well, like I said, I don't do much speculating, and when I do, I have an idea on what would make me exit the speculative stock. And in this case, it was, we had a story that was supposed to close in September. It didn't close in September, and I left the stock.
Yeah, and I think that's probably a pretty good discipline to listen to, and I had rationalized this July 29th date myself. So 9 days from now, they were supposed to get the next decision or no decision, and I'll just lick my wounds and we'll move on. I didn't mean to say you were celebrating. I know you don't do that, but you are fortunate to not have to take that deep breath, and it's not often I see that many digits in red in my brokerage account statement. All right, so let's go ahead and get the party underway. I mean, this slide is not intended to be one that you keep, other than to point out that we have talked about a lot of stuff here over the last year. We thank the audience for many of these suggestions, and I think we've covered some really interesting turf, and that's what we'd kind of like to spend the next few minutes covering. Just having some fun and reminiscing a little bit and kicking around some memories. This whole thing started, just as it says, a year ago, and on this slide, from some conversations with you guys. Following the successful investing conferences, which we nicknamed the COVID cancellation conferences, and we've had 3 of them now. I suspect that there may be a flavor similar to one of those coming up in November here in a few months. So we'll probably continue that tradition. I don't know if it'll continue to be named a COVID cancellation conference, but we will be doing something. And you guys said you were interested in doing this sort of thing. We do want to try to keep these fairly informal, but focused in on stuff that's going on and stuff that we think merits more discussion and exploration. So that is our intent. That's where we'll continue to hang out and experiment. So let's go ahead and take a look at some of the topics and stuff that we have kicked around. This one really came as a pleasant surprise. Ken brought this one to us. And so Ken, would you like to kind of frame what we experienced with this almost accidental book review back in that time?
Well, it's really, in a lot of ways, it's refocused some of my thinking about things. I don't think Google stands still, by the way. And I'm not so sure that some of the premises in this book about Google being a behemoth that was going to be felled by a slingshot from some small contender somewhere. I do think Google moves a lot. They do a lot of experimental things, and like I said, they're not standing still, so I wouldn't count them out in any way, shape, or form. But this whole concept of big data and AI, artificial intelligence, really, after I read this book, I had to kind of rethink where it was coming from. The point was made continuously in this book that AI is not really intelligence. AI is repeating good ideas that come from human beings. And the only power of AI is that you can collect those good ideas by the millions and billions and comb through them to find whether or not there's any kind of pattern to them or any kind of trend going on in those patterns. And then using that ability to comb through all this data and come up with a conclusion that might indeed be helpful and might indeed have been forgotten in the press of all the other information that's coming forward. They also continued to make the point about the amount of pure energy, the costs of mining some of this cryptocurrency, the sheer amount of heat that was being generated in some of these centers where they were putting together the computing power to mine, whether it be Ethereum or Bitcoin or whatever it happens to be. And then it finally also made me question this whole model. Was Google really silly in giving away its entire product for free? Or was it just one of the smartest moves ever made by a business conglomerate? They give away the search properties to anybody that wants them, and those search properties are pretty powerful. And yet Google makes a lot of money, and it uses what it gains from the search properties, our data, it uses it to plug into this whole concept of pattern recognizing, which is a better name maybe for artificial intelligence.
Pattern recognition.
Yeah. So when we're all said and done, this was, to me at least, I'm not going to say life altering, but it certainly changed the direction of some of my thinking about investing.
Yeah, I think it was a great stepping off point. It ended up, we covered it kind of in the first few sessions, and Google continues to be a good investment in our opinion. And I'm with you, Ken. I believe that they will probably reinvent and shift gears and do different things, but it was a good model of taking something and extending it. It's not an easy read by any means. I do think I want to go back and reread it because it's a tough read, but quite interesting, especially in the way that they handle the commerce and the monetization side of things.
Well, I did reread it, Mark, during that time between my first shot and my second shot, when I really wanted to go out and do all kinds of things, but knew that I wasn't really fully vaccinated. I sat down and put my mind to work on this book again. You're right. It's a difficult read in a lot of pages, a lot of paragraphs, a lot of chapters. But if you take the time to plow your way through it, I think there's lots of gems included in those pages. And if nothing else, some of the underlying themes really will set you to thinking.
Yeah, good stuff. All right, let's go ahead and press on. Not going to spend a lot of time on it, just point out that many of our sessions, especially about a year ago, there's 6 or 8 sessions that featured elements of this notion of a projected return on value calculation, PROVE, and how the linkage to the stock selection guide is there. The numerator is basically calculating a projected pre-tax income the same way that you do a traditional stock selection guide, and basically comparing that by virtue of that ratio of the numerator divided by the denominator versus the stock price. We discovered that total liabilities probably made more sense, and the cash in the company's wallet. And you can read the talking points yourself on the right-hand side. We think that it's an interesting tool in our coffer. Our nutshell conclusion so far is that it's a pretty good way to reconcile our return forecasts and perhaps audit. And the analysis of the projected return on value calculation is done without a PE, so that actually provides a really neat check and balance. So you'll see that covered in a number of sessions, and we're not done with that one by any means. We're going to have more on that later today.
From my point of view, Mark, the arithmetic in this formula right here suggests to me at least that for a high growth company, these proof values might increase with increased inflation. I see the numerator moving ahead more quickly than the denominator, and that would mean the numbers, the division would be larger. That's a thesis that I'd like to see tested, in the coming year and a half, if inflation does move forward. And I'm not suggesting if it moves from 2 to 3 or 2 to 4%. I don't think that's inflation going rampant. I think that's maybe more close to normal inflation than inflation going rampant. But if we do move into places where inflation moves up to 8 or 10 or 12%, I'd like to do some testing, because my gut tells me that this fraction will become larger with more inflation.
Absolutely. Kim, would you like to share some thoughts on the importance of capital allocation here, especially in terms of what that denominator looks like?
Well, whenever a company has to allocate capital, you want to make sure management is good at doing it. And they have extra cash, and they have 5 things they can do with that money. They can get internal growth, they can do acquisitions, they can pay you a dividend, they can buy back shares, or they can pay down debt. Now, if you have a great capital allocation policy, and literally I will go into the 14A filing, which is the annual report, and I will search for the words capital allocation, because good management will tell you what the plan is and how they plan on making the company grow, because you will find out their growth business plan. And if they don't, that sometimes is a red flag. And for myself personally, if I don't have a company that has a return on investment or return on capital, or approved, so to speak, greater than 10 and hopefully going up to 12, I'm kind of like, why would I invest in a company when the management's not good at allocating the money that I'm giving them? Because it's my money and I want my capital to be growing. So for me personally, and I'm hoping everyone else in the Manifest community can recognize, this is a big deal.
Yep. Capital allocation, big part of everything. All right. We cover a lot of animals, from bulls to Tasmanian devils to lions. This one was just simply to point out that, in fact, Hugh McManus was a guest for a series on Tesla, where he persuaded the audience that one of the biggest mistakes that investors and rhinos, the Wall Street institutional analysts, make with respect to Tesla is that they think of it as a car company. And it's not. It's a technology company, and now they're even sending people into space. So you're just invited to explore this reality that Tesla is not a car company, and maybe we should think of it a little bit differently and stop comparing it to the big 3 in Detroit. All right. I thought this was one of the more compelling graphs. I thought I'd throw this one in here just for kicks, because this is kind of one of our core principles, especially when it comes to non-core investing. And what you're looking at here are return forecasts for Amazon going back about approximately 10 years, almost 12 years. And you can see that according to the value line low total return forecast, that's down here in the red, Amazon wasn't very attractive, and just kind of underscores the fact from our experience, it's an opinion, that Value Line and Morningstar and a few other sources really struggle with some early stage investing. Keep in mind that earnings did not come into fruition for Amazon until the last few years. In fact, they were infamous for not caring as much about earnings, caring more about cash flow. That's what the CF stands for. And if you do a traditional stock selection guide and convert it to cash flow, you actually do reach a point where you could have been more interested in this company 5 to 10 years ago. One of the things that is very true with early stage investing is if you can prudently get earlier in the cycle and capture some of the more rapid growth, it can be quite rewarding. And we kind of use this as an underscore to the mid-decade selections for the roundtable by Hugh McManus of Amazon. $2,000 invested in Amazon is all the way up to $30,000 or $35,000 now. So earlier can be better. And then, of course, the proof going through that entire sequence just seems a little bit more stable, perhaps something that could be reliable. And as we said earlier, an audit or a conditioning of forecasts, PE ratios used in forecasts, etc. So
you have Len out in the audience and a couple of other people in the audience as well saying, is this Amazon or is this Musk that we're looking at?
I'm pretty sure this is Amazon, because we actually talked about Amazon and Tesla, and we were making comparisons between the two being at different points in their life cycles.
I think that in their short statement, what they were trying to say was that, was it the company or was it the man? Was it Bezos or was it Amazon? Was it Musk or was it Tesla? You know, that pushed the whole envelope and created these disruptors. I think that's the point they were trying to make. It's an interesting point.
Yeah, and it's one that we actually covered in a fair amount of detail, as many of us confessed that the eccentricities, I'm kind of sugarcoating, of some of those individuals, very gifted, talented individuals, but some of them are frankly a little bit weird at times, and that can scare off an investor. And I'll just leave it at that sugar-coated statement of opinion. And I certainly was, I'll say, distracted by some of that eccentricity. So, yeah. All right. Back around that same time frame, we actually used Don Draper to talk about the analysis of a company and sales projections. We always keep a constant look at Apple, and right around the early part of August, we did kick into high gear on our hunt for the red rabbits. That's the small companies that we select every year around Halloween. So we invited the audience to bring them, and you did. You brought several that made it to the list, and we had some fun with that in a number of sessions, but that's kind of where it all started last year. Right around that same time frame, I'll let Ken take this one away. He spends all of his time still lusting for Maria Bartiromo on CNBC. She's moved on, Ken. You're not going to find Maria on CNBC, and you're stuck.
She's on Fox talking to politicians that are no longer in office. So I'm back to my CNBC watching. Not as often as Mark wants to make it sound, but I do watch it. It was interesting yesterday during the one-day downturn that we had. It was very interesting that people began talking about Cramer's cancellation group of stocks again, and they brought this list up and they were showing it to people, and they were wondering, were they going to come back into favor again? They featured 3 or 4 of them that had big gains yesterday, Peloton among the group. And I think it's going to be a group of stocks that will become known as a group even more than as individual stocks. When we're all said and done, they keep referring to it, and it was a quite successful set of picks at the beginning of the pandemic.
Yeah, I mean, this is $100 invested in them back at the beginning of the COVID crisis. And I want you to note some of these values. Now, some of them you can say, well, yeah, that's rearview mirror mark. That's perfect 2020 hindsight when it comes to these two. But that's certainly not true for this entire list. And look at how big these numbers are going down the list. Some awfully good companies there. And yeah, I agree. If they're kicking around some of these, I noticed with great interest yesterday that while the markets were tanking, Kathy Wood's ARKK ETF was actually positive. And I think she's got all of these. So there's a real hint of optimism to that when I look at the bigger picture. The fact that her fund was up while everything else was blood in the streets, and the emphasis there is on ingenuity and innovation, and I think that's a really positive thing for the long-term stock market. That's just kind of my personal observation on it. But yeah, Kramer knocked it out of the park with this one. You can go back and check the performance of the entire public dashboard. It was really something.
Yeah, and it's not so it's not something to really say that's a 12 bagger or a 20 bagger today. But you think when this list was announced, we didn't automatically think to ourselves, oh, that's going to be a pandemic stock and that's a reopening stock, that kind of stuff. We were still just thinking of what's going to survive in the stock market, and choosing a group of stocks that ends up collectively doing as well as this group does. I think our own people in the audience would understand how difficult that is, no matter what the theme happens to be. And he chose this theme, which was pretty spot on, and then picked some pretty spot on stocks to put on the list.
Yep, good stuff. All right, background that time frame, we also covered during the session this notion of just investing in the index fund based on the S&P 500. Not going to go into it in any great amount of detail, other than to point out that the way that you think about this as an investor, again, investing in a S&P 500 index fund for the average person on the street is a heck of a lot better than stuffing a mattress most of the time, especially if you've got a whole bunch of years. But if you go back to the year 2000, we went nowhere in the S&P 500. In fact, it probably lost ground for the next 10 years. And you fast forward to that time frame of 2010, 2011, where we basically switched gears and said back up the truck on the S&P 500, and that's held true for the last 10 years or so. I got to wonder if we're not kind of at a point where they've taken off pretty well. A lot of the large caps, and are we back to Ralph Acampora's 2000? I don't know. It's possible. But I just think Ralph nailed this one, and it's just a reality that you want to be shopping amongst big, medium-sized companies and faster-growing small companies at all time. How'd you like that segue, Ken? All right. One of Ken's favorite themes, friends don't let friends be average investors. I think this is one of our best. And that is a picture of Ken and I hanging outside an Irish pub. I believe that was in Peoria, Illinois. Down at the bottom there.
Is that where that was? Okay.
I think it was. Donnelly's.
I thought this was in Pittsburgh, to be honest.
I think it's Peoria.
Okay.
But good stuff. I mean, this is just some of the stuff that we kick around as one of our core themes. We really don't want to be average investors. We'd like to do better than average. We know that that's not easy, but it is easier with friends. And one of the things that we do, Ardelyx notwithstanding, it is on this slide, by the way. Every once in a while you get stung, but encouraging this notion of core and non-core for those experienced investors who have the right risk tolerance and time horizon and desire to invest in adventure stocks. I'll call them an adventure because I think I qualify today. Your thoughts, Ken?
Well, and that's the very it goes with the very definition of non-core, doesn't it, Mark? That you might have huge successes with a non-core stock, but you also run the risk of having a pretty good stub toe with a certain choice. So you have to take the good along with the bad when you're dealing with non-core stocks. You would hope that the vast majority of your core stocks are well behaved and are not going to necessarily give you huge returns, but at the same time, they're not going to collapse underneath you either.
Yeah, and those are all Hugh McManus mentions there, Walgreen, although I was in on that one with him. That was the best stock for the roundtable in the first couple of years of the roundtable. And then, of course, his I Want to Own a Bank, Bank of America, and Amazon, we've already mentioned. BP, I mean, he was all over that when the Gulf incident happened. And then, of course, Ardelyx here recently, which has been both fantastic and not fantastic here recently. But we do like to talk about Charlie Brown Christmas trees, and I think Hugh actually put out a blue cheese loads portfolio at one point, your screening results. All right, another topic that we kicked around just a little bit a few months into the session was an experience that I've had with a colleague here in Detroit. She had been extremely frustrated over decades. We're talking multiple decades of a nest egg that had gone absolutely nowhere through a number of boutiques and institutions that had not done very well for her. And she basically began paying attention to our Bare Naked Million portfolio and it basically invested very much like the Bare Naked Million portfolio. And she's doing pretty well. In fact, she's fast forward 1 year, that number's actually gone up significantly. So it can be done. She went from watching somebody make literally dozens, if not hundreds of transactions per month in her brokerage account to, I believe they now made 3 selling transactions last year. It's just a whole different way of life and closer to sleep at night investing, in my opinion. So it's a fun one to follow along, and we covered that in a fair amount of detail. But the liberation is a wonderful thing. All right, just some other themes that we have focused in on coming up on Halloween every year. We are a believer in the smaller companies, faster growing companies. And around that same time frame, we began building out our favorite books list also. So we'll take a look at that. But Red October is always in honor of the Red Rabbit and the hunt for quality, faster growing companies. And that was a big part of what we did last year. This is one of my favorite slides. I think everybody should probably equip themselves with this. Every time the discussion turns to Party X has been elected to the White House, or you can fill in any of the blanks, I would just draw your attention to that top graph. I think this is probably one of the best slides you could possibly have for convincing somebody it just doesn't matter. Your thoughts, Ken?
I agree, Mark, especially with all the stuff that floats around you don't want to let the Democrats control everything. You don't want to let the Republicans control everything. I just don't think that from a Wall Street point of view, there's any data to support any of the theories that are out there. They all seem to have their majority positive times. And we've talked about that frequently, about how longer periods of time, we've looked at 5-year periods, but these are essentially 4-year periods. And when you start moving into longer periods of time, you have a very rare occurrence of negative return.
Yep. So don't let the politics enter into it. That was one of the things that I used for convincing that group of colleagues to not run for the hills after the election 5 years ago. All right. During October, we go through a series of sessions. We'll do it again this year, where we're out there searching for best, fast-growing companies to build out this portfolio. Trying not to brag here, also trying not to jinx, but Ken and I have been doing this since Forbes abandoned the effort several years ago, and we're doing pretty well. 6 years in a row, we have managed to outperform the Wilshire 5000, and the relative return is approximately 10% over that time frame. And 2021 is behaving fairly well at this point, also. So
You start knocking on some wood, though, Mark. We don't want to jinx this, baby.
yeah, I jinxed this a couple years ago. We had a massive lead, and we crawled home with a narrow lead at the end. I've never seen a lead evaporate that fast. And
Yeah, unless you're first in the groundhog contest, and the guy that's doing the paperwork is second, then it it moves real quickly. Then sometimes. So.
That goes without saying. Well, here's the companies we ended up selecting for this year. And again, we kind of walked through these, and many of these were featured in a number of sessions. Some of these were featured during the successful investing conferences. The banks jumped off the page at me. I pushed against them. Ken pushed for them to be included in the list. And thank you, Ken. So we basically walked through those, and here are the results as of today. As of yesterday, after a tough day in the stock market, we are up about 40% versus a market over that same time frame up about 33%. So you can see we're in pretty decent shape, and I am knocking on a wood desk right now, Ken.
Good.
But these two kind of jump off. If you'd like to take a cyber bow, Ken. And those banks up at the top are crunching things along pretty well.
I'm only happy that I own both of those, Mark. I can't say enough about Western Alliance that we've put into a couple of our club accounts up this way, but it's also in my personal account. And, I just thank the happy stars, because I was accumulating it over a 7 or 8 month period when a lot of people were telling me I was crazy. So.
And there's a number of Kim Butcher favorites on the top of that list too. Kim, are you?
Yeah, I'm trying to recognize a few of those.
Yeah, I think biotelemetry was presented by you.
That is correct. That's how I found that stock, because whenever you're on a plane or traveling, whoever's sitting next to you, I ask the question, is this business or pleasure? His answer was business. And I said, oh, really? What do you do? And I got his business card and I looked up the stock.
Wow. Well, that turned out to be good. It's a heck of a good theme, biotelemetry for advancing healthcare in general.
I didn't catch this global cord blood removal. What, did it go private or was it bought up, Mark?
They were talking about going private, and we basically took up the offer at right around $6 a share.
Okay.
Back in June. You pretty much can't turn that one down, especially since that one is it's a Chinese company, and who knows what could happen with that one of those. But LGI Homes is doing pretty well, and there's a number of really good ones on there. I do want to point out that my Emergent Biosolutions is not at the bottom of this list anymore.
Yeah, and I also noticed you didn't put Ardelyx on there at all.
Yeah, Ardelyx is thankfully not among our best small companies this year.
Right, we didn't have it in the list this year, Kim. It had gotten a little bit too big for us to put on the list this year. What's happening with Auto Home? Do we know, Mark?
Go ahead, Ken.
Do you know what's happening with Auto Home? I don't. I get questions about it occasionally, but have never found it interesting enough to worry about.
Well, it's the auto trader of China, and
right.
It's affected by all the global stuff that everyone is. In addition to, it's just a real adverse environment for Chinese companies in the global markets. I mean, there's a large school of thought that there's some real fantastic values there. Time will tell, but it's getting punished with all those Chinese companies.
Okay, so we have. Are there any more? I don't see. I'm looking. I don't see any more ADRs on the list. Do you? Is that the only ADR we have?
I think it might be, and I think we successfully talked each other out of a few more of those.
Yep, could very well have.
If I remember, I can think of a few specifically, but yeah, that was fortuitous, at least at this point.
Yeah.
All right, I think some of the most fun we've had actually revolved around a submission of not just one, not two, but almost 20 questions from an investment club here in Michigan. And we spent a couple sessions going over this right before Christmas. I think we can do this one again, Ken. What do you think?
Absolutely, Mark. And I was just briefly talking to you about it before we began the session. Maybe we turn it into a class situation where we can reach even more people as well. This is to me, this was one of the most special things that we did in the entire year. And we got to talk about so many fundamental things that clubs and individuals have problems with, but we also got to talk about things that are not quite so cut and dry, that are much more a matter of style and opinion. And we got to share a lot of different correct answers about things that normally we don't get to talk about.
Yeah, and as an example, here's one of the questions. We covered this a few times over, but we were just talking about relative comparisons of performance, the proper way to do it. In this case, we were looking at a 5-year slice of what George Nicholson called his grand experiment, but using a 10-cup model portfolio, the value line arithmetic average, the BI 100 total return, Manifest 40, which interestingly was pretty high, the benchmark there, and then, of course, the average investor. So we got a chance to basically dive in pretty deep on tackling some confusion and some misgivings, some misnomers, all that kind of stuff when it comes to a variety of investing topics, and a chance to really emphasize all of the above investing. Again, large, medium, and small being very dear to our heart and crucial for investing successfully. All right, so I'm not even sure how it came up. We started listing our favorite books on investing that had inspired or influenced us over the years, and these are all covered over a series of sessions, approximately 3 months, and you can find some wonderful stuff there. Notice the Peter Lynch trilogy here, which many of us cite as being quite inspirational and influential to us. What's your personal favorite, Kim?
Oh, I'd have to say it's a tie between the Rebel Allocator and the Joys of Compounding.
Okay. How about you, Ken?
Well, from pure learning, Mark, I have to go to the kids' book on the list, and that's The Accounting Game. I did not take economics classes at university. I did not dabble in investment banking classes or anything like that. So I was a complete novice when it came to beginning to read financial reports, wading through the vocabulary, trying to figure out what the vocabulary meant, and then trying to figure out what the various tables were telling me. And this book, written at about an 11-year-old level, really walked me through to the point where I don't consider myself by any means an accountant, but I can certainly understand and read accounting reports now and get quite a bit out of them. So I think that's my most favorite book from a learning standpoint. From a pure investing standpoint, I still think it's the manual, fourth from the top up there, that gives still, when you read just randomly throughout the manual, you're still finding things that you ask yourself, what was meant, and how do I apply it today?
Absolutely. So let's go ahead and keep crunching along here. I think some of those are great books. By the way, if you are interested in the projected return on value and you want a little more backup on it, it's a close cousin. It's not exact, but Joel Greenblatt's book up here is part of the inspiration behind that concept. Something you might want to think about. We do tie in the monthly programs with some of our other things by the fireplace here, the golden statues we give out for roundtable performance during our February program. So I just wanted to make the point that every once in a while we do sneak in linkage to other events going on, whether they're national events or local events, etc. I threw this slide in here just as a reminder that sometimes we take up fairly unusual topics that come from virtually anywhere. Like Matt Spielman comes up with some really neat areas to burrow into. This one happened to be a conversation which erupted over commercial real estate and the conversion of vacant mall space into residential living. And we covered that for 2 or 3 weeks and just offered up as an example, along with obviously keeping track of stuff that's been put out there by Mr. Buffett at Berkshire Hathaway. All right. Let's just keep cranking along. We have fun with some of the holidays. Everybody's Irish on this particular day, including
Mark,
Matt Spielman.
when you're repeating great stocks, I'm getting poked here by one of our younger audience members to remind you that he told you about SWCH, switch.
Tell him to get back to work.
This is coming from Sean, and I think he's needling Mark just a little bit. So.
He is. Sean is going to be helping us out a lot here in future days. So stay tuned and be watchful for Sean Mace. One of the things we also added to the program is going back in basically at the session preceding all of our roundtables, we try to go back 4 years and see if we might extract some lessons in our retrospective features. That's the Chicago River being dyed green, by the way. It used to be the view from my office at one point. And then just some other stuff going on. Kim brought us Stocks Under Rocks from the Birken Road people down at Tulane. We do keep track of the groundhog here until we get the groundhog scoreboard up and running here. Hopefully soon. Kurt has begun working on that. And I do want to point out that there are a number of sessions where we do talk about the sell strategy update, something that you can watch for, and that's something we're never going to let up on. And then just as one other example of a topic which we covered, this notion of the relative strength index, RSI. You might want to check it out at stockcharts.com. This is that day which shall forever live in infamy, March 20th, 2020. We actually put out this list of companies that had really low, in other words, way oversold, undervalued, potentially, companies, and basically spent some time talking about how the RSI can be a source of ideas. We will be adding RSI to things that you can screen on at Manifest Investing. So if you want to understand what it is and how it can be useful, we went back and looked at how those companies did over the next several months. A subset of that group that was actually identified on March 26th, and you can see that they basically hit it out of the park. They did prove to be truly undervalued and oversold. So there's some pretty interesting names on that list. I will admit that I actually bought shares of Wolverine Worldwide, so I get to do a jig on that one, Ken.
You do, and it's fascinating, Mark, that the total return column is entirely green. I mean, I understand that the relative return on farmers and merchants is not real good, but still, I wouldn't turn my back on a 20% return stock.
No. Nope, there's a number of very interesting companies in there, and they've been quite rewarding. Kim, did you have thoughts on that?
I just always enjoy finding a stock that's undervalued to make money on. I'm just simple.
Well, that's where that RSI can be most helpful. So we fairly recently we had a session that we basically spent the entire session talking about the core of our discipline and strategic long-term investing. And I would invite you to check that out. It's one of the more popular and well-received sessions that we've done. And that's fairly recent history. So you're just invited to do that. So with that, let's just take care of a couple of items as we leave today. We've been updating the groundhog every time we get a new sheriff in town or there's an interesting move. The interesting move this week is everybody got hammered by what happened in the stock market yesterday. The average return is down to 2.4%. We have the lowest number of entrants beating the market since we started doing this. And Kathy Wood is 137th out of 144. But I would just urge you to notice that there's a number of clubs bolded up at the top. Ken is in that one. Ken is in those. These are among the 19 clubs that Ken is a part of. He's got 3 of his 19 clubs on the list, and I think you're on here by yourself. So Ken, you just
I can't beat my clubs. I don't know what's going on here.
Yeah, I see that Saul keeps crawling back up higher.
Yeah, and we've got Nick. I've been watching Nick. Nick D is just climbing the list. So good, clean fun. Some interesting things there. I hope to have the full scoreboard up and running shortly. This is just a clarification and a reinforcement of our Fave 5, which we kind of kicked off again. What type of secondary screening activity, because we basically are always looking for undervalued, high-quality companies, but then also tossing this in as kind of a refining screening element. And we find, again, our interest in the RSI is based on this. The Launchpad is a reference to companies that have exploding earnings expected, made famous and popular by our all-time leading investment club out of St. Louis. The name of the club is escaping me now. I should have written it down here. Anyhow, the Ruby Lawrence and her band of investors down in St. Louis, they kind of set the standard for identifying those type of companies, and they've used it to basically dominate the long-term groundhog results. Manifest rank is just companies with good quality and return forecast, and you can see why we are interested in projected return on value also. All right, and one last topic for today. I know we're running a little bit late, but I think this one's kind of cool. Tom Gardner was talking about Visa the other day, and how has it ever been a good time to sell Visa? And he thinks the stock, Visa, ticker symbol V, so far never. And so I just went through and demonstrated that, yeah, he's right. And there's the chart. Matt Spielman pointed out, notice how often this has been overheated or potentially oversold. And it can be that way for a long time. It's just something to always remember that I think Nicholson's words for it, when you have a double-digit growing company, you just want to be really slow to sell. A true growth company that's very high quality. This one certainly fits all of those aspects. So, and Ken, I know you have pointed out that RSI is just one piece of information.
Right, and Mark, our discipline about core and non-core and holding core stocks until their par value falls below that of money market returns helps us to avoid this in and out of a stock, especially a high quality core stock like Visa.
Yeah, and I think the Chronicle over the last 4 years really captures that. There are a number of times when it was technically oversold, but I would challenge anybody to find a sell signal for a core holding on that chart. Then over the last several years, you can see that the fundamentals have just simply been intact. Certainly nothing wrong with it. It's got one of the best quality portfolios in the entire universe. I think there's only 3 or 4 companies in our coverage universe that actually are equal to or better than Visa. So all of that being true, and then I find this one kind of interesting. Went back to take a look at projected return on enterprise value, and this is where we'll close. I think what we're looking at here is a company that is just knocking it out of the park and performing extremely well with extremely high returns to shareholders, but keeping that going is really a challenge. You can see that their liabilities have been creeping up over the last several years, so they're taking on more debt. They've been buying back a number of shares. The tax rate's in there a little bit. Again, as you become more familiar with the projected return on value, you can see, again, nothing to be panic run for the hills about, but I do think they're a little different environment here versus back here. And it's looked so good for so long. I just think it doesn't look as good. It still looks good, but it doesn't look as good as it did 10 years ago. And again, this is some of the stuff that we're going to be digging into and exploring, inflation and how that affects this picture over multiple decades, all that kind of stuff. What are your thoughts, Ken?
I agree. I've never found a time to sell this stock, and it's just an example of the kind of stock you put into your core holdings and that you don't worry about for a long time. That doesn't mean you never worry about it, but you don't worry about it for a long time. And right now, I'm in the middle of that long time period.
Yeah, it's no Ardelyx.
Yeah. Mark,
I'm knocking on wood.
Our audience is so good at coming up with any answers you need. That's the Broad Assets of St. Louis, the club you were trying to come up with.
Thank you so much. How could I forget Broad Assets?
Yeah.
It comes with that rapid passage of time and getting older, I guess.
Yeah, just wait till you tag 10 more years on it, Mark, okay?
Well, I'll forget I ever said this 10 years from now. All right, just as a reminder, we do archive these recordings for bull sessions. You'll see a number of them on the page, along with our reviews of expected returns and our roundtables, which are our monthly programs. Just a reminder that is all available if you go to YouTube, search on Manifest Investing. And again, please consider subscribing if you find this stuff useful, and you get a reminder anytime content is added. And feel free to explore. And so with that, I'm going to leave us with a picture from a dear old friend who used to be a wonderful colleague at the National Association of Investors, Better Investing. Mark Stevens kept all of the computers happy in the publications department for Better Investing. So that's my connection to Mr. Stevens, and he's a heck of a photographer. This is hot off the press, just a few days old. Picture that he captured up on Lake Superior, and I just think it's cool. And so that's why it's here. So thanks, Mark. All right, and so with that, thanks for the last year, everybody. A number of our contributors are in the audience, and we greatly appreciate the stuff that you have inspired us to do. Please continue to keep pushing on, and we will see what entertaining and informative and bolstering ventures we can discover in the year going forward. Any final closing thoughts, Ken or Kim?
No, we have just a question or two that we'll handle after we close down, but I'd like to thank Mark for doing this and for inviting me to be a part of it. Wasn't sure that I wanted to do a weekly event, but now that I'm into it, I really do enjoy it, Mark.
Yeah, I think it keeps us fresh and inspired. Kim, your thoughts?
Well, I want to thank you guys for letting me join you, because you guys listen to a woman's point of view, because sometimes it's a little different than you guys.
No doubt about that, and I'm getting accustomed to the ladies being right an awful lot.
I'm well trained, Kim.
As my wife, when she asks me to do something, I just say, yes, dear. How high? All right. So with that, we're going to go ahead and say happy birthday to Bull Sessions and keep pressing on. Keep in mind that we will be convening a week from now, and then we also have our monthly roundtable a week from today. Thanks, everybody.